My base case is we're heading for a bear market, so a peak to trough decline of at least 20% in equities.
Volatility on financial markets is at its highest level since COVID. It must be a difficult time for traders. How do you think they're approaching markets?
Oh, look, they're a bit befuddled. Unless you've got an inside running on the President's tweet feed, you're really just going to get buffeted by rumours, headlines and really a cacophony of commentary coming out of the White House. It's not even got a consistent story. So markets are exceptionally whippy, both in day trading and overnight. So it's a 24/7 job at the moment, keeping on top of the turbulence.
Markets are pricing in bets, essentially, on the future performance of companies. What are the markets saying about how Australian companies are placed to respond to the US shift away from globalisation?
They don't like it, is the short answer. I don't think investors here are so worried about the direct impact of, let's say, the 10% US tariff on Aussie exports. It's much more the secondary impact on what this may mean for the global economy. And you're seeing that in both the Aussie equity market and also the Australian dollar, which has fallen 3 or 4 cents since Liberation Day. And that really is a symptom of concerns about the global growth cycle as much as about the Australian economy.
In recent times, markets have been trading at record highs. If valuations have been overstretched, are they beginning to look like fair value?
No, I don't think so. Depends which market you're talking about, of course, but if you're looking at US equities, which at the peak were 2/3 of global equities altogether, they were at monstrous valuations. Valuations that you'd only really seen once before, which was at the top of the TMT bubble 25 years ago. So although we've had double-digit declines in US equities, I still think they look unattractively priced and a mile away from where you have a fair value, even in the near term, with upside. Australia, we don't look cheap. We weren't as expensive as the US, but if you extract the mining sector from the Aussie equity market, we were almost as expensive as we've been since the tech bubble before this turbulence. So we were starting from a relatively expensive position as well, just not as expensive as the US market.
The ASX is already in correction territory. Do you see it entering a bear market?
I think that's a reasonable chance. Look, what we're seeing is absolutely a seismic shake-up to the global trading system. And even if there is the start of some negotiations with the White House, I think investors should start to realise we are not going to go back to where we were pre-Liberation Day. The other thing I think that's unsettled investors is not just the size of the tariffs that were announced last week. It's the fact that they've been rattled by what they thought was going to be the big check on Mr Trump. After his inauguration, everybody thought two things were going to restrain the president. The first was some adults in the room. Well, they seem to be absent. But the much more important factor that Mr Trump would not disappoint markets. Well, he doesn't seem to care about markets. And that's really opened up concerns that he could be serious. And if he's serious, I don't think enough downsides in the price. So, yeah, my base case is we're heading for a bear market, so a peak to trough decline of at least 20% in equities.
You're the bear who predicted the GFC. Can you give us a prediction today about the direction of the global economy and, of course, the Australian economy as well?
There is a silver lining to what the Trump disruption is doing. He's catalysing important positive reactions in the rest of the world. And I'd highlight two in particular. One, we're seeing more fiscal loosening in Europe, particularly led by Germany. And secondly, and this is a significant and way overdue move, Chinese policymakers are starting to focus on their own consumers and starting to deliver some stimulus. Now, these positives may not avoid some near-term turbulence, but it ultimately means if you're looking into the back end of 2025 or into 2026, I think there could be real opportunities for investors in non-US markets because the rest of the world may pull themselves up by their own bootstraps in response to this turbulence from the US president. US equities, I'm less optimistic on. Ultimately, tariffs are going to involve a misallocation of capital. That means lower returns, lower profits for the average US corporate. And the US equity market started much more expensive than markets elsewhere in the world. For Australia, we're somewhere in between. We've had a fairly poor decade of economic performance. a fairly poor decade of equity returns, and this current election campaign, I can't see either major party addressing the structural problems that have really left the Aussie economy in a rut and the equity market looking mediocre at best.
Gerard Minack, great to speak to you. Thank you.
You're welcome.